Now let's just put this 4-hour alignment into a live perspective. So what I was talking about is to find the 4-hour direction, find the 4-hour trend, either bullish, either bearish. Ranging structure is great as well, but we will talk about later why I'm talking about the entry levels. Now let's just talk about real structures, bullish or bearish structures. Here is the first example on USD GPI. On USD GPI, we have a really clean bearish trend where price has created the swing high point. From the swing high point, it started to drop down, and now it's forming series of lower lows, lower highs, breakout structures, and sweeps. So we identified we have a beautiful bearish 4-hour flow, which we can trade in, right? So we are looking for 4-hour entries, just like we took all these trades that mark out here on the screen. We took all these trades on the 4-hour time frame, entering here on the 71 level after having a sweep of liquidity here. After breaking the structure to the downside, we entered into all of these opportunities. Actually, there were three. One more was be found right there, but we entered there on a 4-hour time frame. But the purpose is to line up the 50-minute with the 4-hour time frame. And as I told you in the video, you are looking for three types of entries. First entry is the retracement. Logic is once again simple. You know that price swept the liquidity out here. You know that price broke the structure here. You know that there is volume, there is order block or even order blocks. There are all the criteria you need. So what you expect that price will do is that it will retrace back up to your entry point, right? So this is how you are lining up the 4-hour perspective with the 50-minute one, because you are expecting the 4-hour time frame to do something based on the criteria you are using, based on the analysis you are using. You are expecting the 50-minute flow lining up with that 4-hour expectation. And what you are expecting, based on the limit order you are setting here on the 71 level, what you are expecting is that price will retrace back up to this level and will drop down from this level. And you are only taking the 4-hour entry here, and you're missing out from lots of opportunities on the 50-minute time frames because you are expecting the 4-hour flow to come up and drop down from here. So why wouldn't you utilize on all these movements which are lining up with your expectations? Once again, you are expecting that price somewhere. We didn't know that price will reverse here. We didn't know if price will reverse here. We did not know a thing about reversal, but what we know is that somewhere price will reverse back up to this region. It can happen deeper down there. It can happen even deeper down there. It can happen higher on the move somewhere around here. We did not know, or we do not know where price is retracing, reversing back up to the 71 level entry, but we just simply expecting it to happen because this is the whole strategy, right? We are expecting retracements back to the 71 and then drop downs in a bearish flow. So why aren't we utilizing on this whole flow by taking reversal trades when the retracement happens? So here on the retracement, you know, what is retracement? Where you are pulling to the zero Fibonacci level. You are pulling from the 1 down to the 0 where price retraces back up to your entry. So why aren't we capitalizing on these movements, utilizing on these movements when we know that these are coming back up to the 71 level? Here, first of all, you are lining up the 50-minute time frame order flow with the 4-hour expected direction. So you are aligning these two time frames together. You are expecting price to come up to this level and down, and now you are expecting price to drop down. So you are lining up the 50-minute flow with the 4-hour, expecting these longs up to this 71 level, taking all these long opportunities leading up here. Then you know that price might drop down from the 71. You know that this is a really crucial and strong level. You know that, yeah, you have a limit order here and you're expecting price to drop down from here. So what you are doing is that you are confirming these levels. You are confirming, looking for a confirmation somewhere around here where price can drop down from, and you are once again utilizing on the second 50-minute lined up, aligned order flow movement that lines up with the 4-hour expectation. Because the first expectation is that price will come up. The second expectation is that price will react on the 71 level. And the third expectation is that price will drop down. So based on these three expectations, we have three entry handles. And the third entry handle, based on the expectation of continuing the movement to the downside, which will break the external low again, We will take continuations because why on earth we wouldn't capitalize on all these 50-minute movements which will look like this. This 50-minute flow is leading down to this 4-hour structural point, and you want to utilize on these movements. You want to scale into these movements because this is what lining up the 4-hour with the 50-minute time frame means. You are lining up the 50-minute flow with your 4-hour expectations. And from these expectations, you will have three completely different entry models that you will be able to make money with. And you can replicate this on and on and on later price action movements, just like it has happened here. Once again, you have the flow. You have the beautiful bearish flow coming down, right? You have another sweep of structure. You have another break of structure. So here is your 4-hour protected high point. Here is your retracement point. This is the original 4-hour entry. Coming up from the 71 level, you are expecting a drop down to hit your TP on the 0 level. We did that. We entered there. We entered here on the 71 level, and we just made 2.5 nice % profit here and here and here. But with the 50-minute time frame flow, you will be able to make so much more money risk reward ratio by scaling into these opportunities. And here's an important thing again, that you will lose money as well because the win rate is lower. I'm not selling anything false. No, you will have a lower win rate, but the high risk reward ratio will compensate for the more losses you're going to experience. So once again, you just have a nice flow. Price is coming and dropping down in a bearish structure. Here's another sweep. Right. You have another break. Right. What you are looking here, what you are looking for here, you are expecting price to somewhere retrace back up to your 71 level. You are pulling the Fibonacci from here to here, then here, then here. And when the retracement starts, you will have a beautiful retracement flow coming back up to your 71 level. And once the 71 level is mitigated, you are entering in a 4-hour strategy entry. Here on the 71 level, stop loss here on the 0 level, 1 level, and the stop TP on the 0 level. Yeah, now you are looking for another confirmation, expecting a confirmation there because you're expecting price to react there. And here from there, the third expectation comes into place again. You're expecting price to follow this movement, and you are lining up that 4-hour expectation of a drop down with the 50-minute actual order flow happening here, and you're going to scale into lots of trades that are lining up with that 4-hour flow. So this is how you are using your expectations, because everything in Forex is made out of expectations with the actual flow on the lower time frames.